Have you ever wondered what steps you need to take and what mistakes you need to avoid before you buy a house? In this video, I'm going to go over the top 5 steps you should take if you want to become a homeowner in the next 12 months and some of the mistakes you should avoid to get you there quicker. My name is Fred Chilton. I'm a mortgage broker here in Texas, and here are some of the top mistakes that I see that people make that prevents them from becoming homeowners. Number 1, people don't talk to lenders before they go shopping for a home. So they're just window shopping, looking for a house without knowing if they're comfortable with the payment. So the first thing that I would do before you start any of this is talk to a lender, preferably a broker, because they can shop your rate with 40, 50, 60 different lenders to get you the best deal possible. Even if you're not planning to buy a house for a few months from now to up to a year, I would still recommend talking to a lender. That's going to give you a good baseline of where you stand and what you need to do to get you that dream home. Now with a lender, you can get something that's called a pre-qualification, which is where you don't pull your credit and you just go over based on what you say. Or you can do what's called a pre-approval, which runs your credit. It's a hard credit pull. It also checks your income and makes sure you have assets for a down payment or closing costs. Now, if a down payment or closing cost is something of a worry to you or you feel like you don't have enough, stick around till the end. I'm going to show you how you can get some assistance with a down payment or closing costs that'll help you get into your dream home. A second step that you should take to prepare you for home ownership is to review your credit. Now, you can do this a couple different ways. On the lending side, a lot of us brokers have access to something called a soft pull credit check. So this isn't going to pull your credit. It's not going to ding your credit. It might cost you $20 to $30 to do so. Some do it for free, but this looks at your overall financial standpoint from the credit perspective. So we'll be able to see what kind of debts you have, where your credit score stands. And if you have a good loan officer, they'll actually tell you how to increase your credit score if you're not where you want to be yet. So this is why it's crucial to talk to a loan officer. But here's a really cool thing though. This is what I use personally. If you don't want to talk to a loan officer just yet, you just want to see where you stand, go to myfico.com. It's not going to be a hard credit pull because you're checking your own score. It might cost you $20, $30, $40, but trust me, it is worth it. I'm not sponsored by them, obviously, but this is what I use for myself, for my family, whenever we want to see what our scores are, where we stand, some simulations. Where myfico.com differs from other apps like Experian or your credit card bank app is that it tells you all of your credit scores, including your mortgage FICO scores, because there are over 16 different variations of credit scores out there, and Experian and your bank scores only give you one out of those 16. Number 3, and this is what disqualifies a lot of people, is that they have a lot of high monthly debts, especially car payments. Look, I know a lot of people may want to show off in front of their friends and drive the Ford Raptor or a Tesla, but this is what's disqualifying a lot of people, is because it's a high monthly payment on a car note, and that eats into your debt to income ratio. That's something that we look at on the lending side, and it's pretty simple. It's whatever debts you have versus how much money you bring in pre-tax. So let's just say you make $10,000 per month and your debts on a monthly basis, including your car, including your mortgage, including your credit card, student loans, come out to $5,000 a month. You're at 50% debt to income ratio, and for some loans like conventional loans, that disqualifies you. So before you start looking into buying a house, get rid of as many of your monthly debts that would pull up on a credit score, or just don't buy that expensive car. 4, start saving for a down payment. Now, there's a huge misconception out there saying that you need 20% down to buy a house. To me, it seems like that's a huge deterrent for people that are my age group or younger from buying a house, because where the hell do we get 20% down from? Now, 20% down might have been easier back in the 70s or 80s when homes were about $80,000, but in today's market, 20% is a little bit hard to get, and all you're doing by putting 20% down is avoiding something called PMI, or private mortgage insurance, and that typically runs anywhere from $50 to $100 per month. You can get a way better return on your money by investing in stocks, indexes, bonds, etc., etc. Talk to a financial advisor about that. But a lot of people don't know that you can buy a house with as little as 3% down if you're a first-time home buyer, or 5% down if you've owned a home in the past 3 years. Now, we just covered a step where you need to get rid of your high monthly payments before this, so it may be hard to come up with, 5, 10% down, whatever it may be. If that's the case for you, you can get something called a down payment assistance program. There's a few out there. There are down payment assistance programs that range anywhere from 2% to 5% down payment assistance. These are great to get you into a house. The only drawback with these is that the interest rate is going to be slightly higher than a typical mortgage, but it's still going to be FHA, conventional, VA, USDA, same exact parameters. It's not harder to qualify for a down payment assistance program. It's actually a little bit easier. And there are even some down payment assistance programs like grants that are forgiven after 6 on-time payments. So let's just say you get 5% assistance, you pay that higher payment on the higher interest rate for those 6 months, and then after that 6th payment, that down payment assistance is fully forgiven. So I hate using the word free, but in a sense, it's like free money for paying an extra $200-300 per month to get you assistance of 5%. And let's just say that 5% down payment assistance is on a $500,000 house. That's $25,000 that you're getting for free. That's $25,000 that you're getting for free for taking a slightly higher interest rate. If you've made it this far, this is where the fun part starts. This is where you talk to a realtor. Now that you've got your ducks in a row, you've got everything figured out, you can go to your realtor and say, hey, I'm pre-qualified or pre-approved with so-and-so lender. I'm ready to start looking for a house. That realtor will respect that so much. And if you find a house that you like, you and your realtor can put an offer on that house confidently, knowing that you'll be able to afford it. And if you've spoken to a lender or broker, knowing that you'll be qualified for that house itself. And that takes so much of the stress out of the equation. If this video is useful, do me a favor, like, comment, and subscribe. Again, my name is Fred Chilton. Thank you for joining Mortgage and Chill.